Good morning. Welcome to the investment meeting of the Teachers Retirement Board for November 2nd, 2023. I'll start by calling the roll. Kevin Liu,
Kevin Liu, representing Mayor Adams.
Thomas Brown,
Good morning, Patricia. Present.
Anthony Giordano,
Tony Giordano, present, representing Pet Chair Gregory Faulkner.
Allison Hirsch,
Allison Hirsch here representing Controller Brad Lander.
David Gazansky,
Present.
Victoria Lee.
Present.
We have a quorum. I will turn it over to the chair.
Good morning, everybody. We start today's meeting with the Passport Fund September 2023 performance review, and I think Robitan will take it from here.
Thank you. Good morning. And I'll
Good
pass
morning.
it over to Amanda, who's joining us with Zoom.
Hello, everyone.
Morning, Amanda.
There we go. All right. So the month of September has a reputation of being a negative month for market performance. And unfortunately, that did hold true for September of 23. In terms of the market backdrop, we had inflation continuing to moderate, which was positive. The Fed during their September meeting held their rate steady, but did revise upward their median forecast for where rates will end at year-end 2024. Sort of reinforcing this higher for longer expectation. We also saw 10-year yields continuing to move higher, higher oil prices, and we also did ultimately avoid, but for a while we're in limbo around a potential government shutdown. So with that as our backdrop, we did see risk assets sold off pretty much across the board. And you can see that here in the September results of the Passport funds for the month of September, all in negative territory, although, low to mid single digits here for the Diversified Equity Fund, down around 4.5% for the month of September, with US equities a little bit harder hit than international during September, all down in sort of mid 3 to 4% range, although still solidly positive year to date. You can see those returns calendar year to date through the end of September for the Diversified Equity Fund, up over 10%. For the month, your best performing option was the Balanced Fund. Not surprisingly, is the most conservative option in the Passport funds. Was still in negative territory, down around 1.6%, although positive year to date, close to a 4% return. And then the Sustainable Equity Fund on the flip side of that was the worst performing fund for the month of September, a little bit more aggressive certainly than the balanced option, although that fund has had a very strong year up until this point, and you can see that reflected in the year-to-date returns. That fund up close to 21.5% calendar year-to-date through the end of 9/30. So overall, for both the month and the third quarter, which you can see reflected in that 3-month period, negative returns across the board for each of the Passport funds, although modestly and on a year-to-date basis, still in very strongly positive territory across the board. I'll pause there and see if there's questions.
Any questions for Amanda? Thank you, Amanda. Appreciate it. Move on to the October 2023 market performance update. Robitan.
Thank you, Tom.
Thank you, Devin. Yep.
Continuing with the theme from Amanda on September, October continued to also be a challenging month for investors as well, as we saw declines across all major asset classes. For the month, we saw the global market composite down by just over 3%. The diversified equity fund also down by 3% as well. However, year to date, the performance is still positive at roughly 7.39% and 7.21% respectively. The best performing benchmark for the month was the balanced fund that was only down by 0.95%, again still positive for the year. And the worst performing benchmark was the international composite, down by 4.26%, still slightly positive for the year, up by 0.9%. So I guess the general theme here for the month is that we did see a challenging month for investors. However, there is some resilience. I mean, we did get the announcement that the US economy did grow by 4.9% for the quarter, annualized. And yeah, I will just pause here for any questions.
Thank you, Devin. Any questions for Devin? Thank you. Thanks, I appreciate it. We move on to the strategic asset allocation discussion. Steve and Mike, I guess, want to chime in?
Great. Yeah, maybe I'll just make an introductory comment or two. This was a follow-up topic. I'm going to try to pull up the materials for anyone following along. Here we go. This is a follow-up to the discussions we'd had over the last couple of meetings around the SAA review, which many will recall is something that the board is looking at approximately every 3 years or so. Let me just share my screen here. So today we are presenting, as it's noted in the materials, a recommended portfolio for the board to consider approving. This is a portfolio that, compared to the current.
Sorry, is there a way that we can change the pinned image so we can actually look at your document instead of ourselves? There we go. Thank you.
Thank you.
Good. Okay. So as everyone can see here, based on the current risk profile of the current portfolio, we're expecting compound returns looking out over the next 10 years of approximately 7%. What we were thinking about in terms of this asset allocation was how could we potentially, move the needle a little bit more toward more above that 7%, right? With some hopefully higher probability of achieving the 7%. We do know that in late 2022, excuse me, New York State did approve a change to the RSSL basket clause rules, which permitted up to 35% of basket assets in the portfolio. So we knew we had this additional flexibility from a constraint perspective. We wanted to understand how that could be reflected in a potential change to the strategic policy of the fund. And we also wanted to take into consideration our current or latest thinking as it pertains to the look forward on markets. We're in a very different market environment today than we were 10 years ago. We're in a very different market environment, I would say, today than we were 3 years ago. So we have, as you'll know, certainly more return expected from fixed income assets today by virtue of the higher yields that we've seen over the last year or so. Taking all of those things into consideration, we wanted to understand if we were going to deploy incremental levels of risk in the portfolio in the hopes of shifting the distribution toward the upside for the pension, where were those next best dollars to be deployed? And so using some of that flexibility, you can see the biggest changes here at a high level from the current to the recommended are taking down very slightly by about 3% the public equity allocation. Taking down very slightly the public fixed income allocation. You can see that's coming down by 3% as well, and redeploying those assets into alternative markets or private markets over time to try to capture what we would expect to be a return premium relative to the public markets. That's not to say we think public fixed income or public equity are unattractive today, but we would expect over the long term to get an incremental return for the incremental risk we're taking in alternative markets, and also the active management premium that comes with those asset classes. We would hope the system could benefit from that premium over time. And so the biggest changes here are taking down those allocations to public markets, increasing the allocation to alternative markets, and specifically within alternative markets, focusing on slight increases to private real estate, private infrastructure, opportunistic fixed income, and a more notable increase to private equity. When we look across public pensions in this country, these allocations, I would say, will bring you to be a little bit more in line in terms of the alternatives allocations, which we generally see are a little bit higher for other publics. And so you'll be a little bit more in line there. All told, the expected risk and return profile of the new allocations, I would say, are not meaningfully different than where you are today, but we should expect to see some incremental return for the incremental expected risk or volatility that we would be introducing to the portfolio.
I would also add, the increase in alternatives, I don't think that puts us out of line with peers. In fact, I think we'd still be underweight.
Still be underweight.
Alternatives relative to peers out there. So even though obviously deal flow has gotten more challenging in, say, private equity, things are cheapening up, and as we increase, or if you opt to increase the exposure to private equity, that'll occur over the course of years. So we do think it's a great way to pick up hopefully some relatively attractive deals, and through that vintage year diversification, do it prudently over time. There are many other investors out there that have an overweight, given the denominator impact, the fact that we had such a decline in public bond and stock prices last year, that they'll be deploying less money into these deals, which puts us in a position where we're able to better negotiate stronger economics, meaning lower fees, and have access to the very best managers that are out there. So the timing, I think, is probably pretty good.
Yeah, and I think it's important to remind the board that with an approval such as this, you're not flipping a switch and moving there overnight. It does take time to transition to these new targets and deploy capital into private markets.
It's also recognition, particularly in private equities, we're already over target by about 1.8%. So it's a recognition of that. It gives us more room to continue to deploy money as things are cheaper. Private credit, we think, is also a great area to invest in, with returns between 10, 12 to 15, depending upon the structure. And again, infrastructure, I think, has proven to be a great inflation hedge and a strong performer. I think the other thing, Mike, and correct me if I'm wrong, we were asking to combine real estate, core, non-core, just to have flexibility to toggle between the two. Because some of them, and may have blended strategies as well. It looks like some element of core, some element of opportunistic. So I think that's cleaner.
The last thing I'll mention is, we could see public markets sell off very quickly and be in a position where the denominator effect puts your alternatives allocation or your basket allocation much closer, or if not, maybe at times above that 35%. We think this level here at about 29% at target to basket assets does provide some cushion as well for that.
Mike, Steve, I heard Mike say we're in a different market environment than we were 10 years ago, 5 years ago, 5 days ago, perhaps. And I know we review this every 3 years or so. 3 years seems these days to be such a long time period.
Yeah.
You'll get back to us if anything develops. Who can predict what's going to happen with the wars and with the political season coming up? So if there's anything on the radar that you see that you think we'd be interested in, you'll come to us sooner than that 3-year period.
Absolutely.
Oh, great.
But I think it's also fair to say that we're not trying to be tactical here. We're trying to be strategic, and this is kind of a building an all-weather portfolio should perform strongly over time. But of course, as things change. So, Mike, I understand from some of the consultants that upwards of 25% of clients have actually undertaken the reviews, strategic allocation reviews, this year because of the move up in base rates last year. I think, Mike, I don't mean to speak for you, but that's one of the things you're alluding to, is the fact that money's more expensive now and base rates relatively attractive. So a lot of other public pension plans and corporate pension plans have undertaken that review because of the change in base rates. I suspect if you had something that dramatic, you'd accelerate that time frame for review inside of 3 years.
Yeah, and just to say too, that's not to say we expect yield rise to
Of course,
continue
of
or with the
course.
same trajectory or speed that it has, but yeah, if we see the environment change materially.
Perfect, word's great.
As you know, we meet monthly, so we're.
Yeah,
regular
that's,
contact.
that's a comforting feeling knowing that. Great, thank you. So do we have any more questions for Mike or Steve?
Just one clarification
Sure,
for me,
David.
is regardless of how we move our asset allocation, the rebalancing ranges are still the same as they have been previously.
Yeah, I think the equation for the rebalance for the, say, private equity is that 1/2 of the target rounded up. Is that right? Like, so they'll adjust a little bit, but we don't take liberty. We're not trying to time. We're not trying to be
No,
tactical.
never.
But yeah, they don't change. They don't change.
Yeah, I was gonna say, to the extent we're looking at that and making the changes in the policy to reflect this updated target portfolio, we'll review the ranges as well, and if we have any suggestions on potentially changing those for the parking places, we'll come to the board for approval on that.
Okay, great, thank you. Thanks. Any questions from Mike or Steve? Normally we would do a consensus, but I think we'll take a vote for the strategic asset plan now. Because it's one of our most important things that we do, and then we have to vote at the board meeting. Okay, so why don't we just get this on the record? Do I hear a motion to accept the strategic asset allocation?
So moved.
Is there a second?
Second.
Thank you, it's been moved.
So it's just so we're clear, it's the recommended.
That's right,
Yeah.
I'm sorry, you're right. Let's get on the record, the recommendation.
Yes.
So moved, it's been seconded. Any questions about the recommendation plan? And all those in favor accepting the recommended plan, please say aye.
Aye.
All those against, please say nay. Abstentions? So let the record show that we accept the asset allocation recommendation. Thank you.
Little housekeeping matter, I don't know if it's Rokutan or BAM, if you could get us the slide with the actual,
Do you include that in the resolution?
because we'll include it in the
Absolutely.
resolution
Yep.
as an attachment.
Great. We'll vote on this coming up in the next board meeting. Great, so I guess that's all the work we have to do in public session. Do I hear a motion to go into executive session?
So moved.
And a second?
Second.
Great, any discussion? All those in favor of going into executive session, please say aye.
Aye.
Those opposed say nay. Abstentions, we're now in executive session. We are now in public session. Swingle?
Thank you. In executive session of the passport funds, there was one manager update. In executive session of the pension fund, there was a presentation on preliminary performance data. There was a presentation on emerging manager allocations. A request for policy update was made and consensus was reached. There was an emerging manager and MWBE presentation. Discussion followed. There was a waiver request on a specific investment. Consensus was reached. And there was an infrastructure presentation in which consensus was reached.
Oh, to the lot. Great, thank you, Ron. So here a motion to adjourn.
So moved.
And is there a second?
Second.
Any discussion? All those in favor of adjourning, please say aye.
Aye.
Those opposed, say nay. We are officially adjourned. Thank you, everybody.
Shortest meeting we've had.
No, yeah.